All right, welcome back. Tariffs are not causing a spike in inflation, at least not yet. The Fed's so-called preferred inflation measure is the Personal Consumption Expenditures Index, thankfully better known as the PCE. It tries to gauge changes in prices that you may know or see every day. And that number came out this morning. It came in line with expectations. So let's talk more about that and any moves in the bond market, or really what will move the bond market. Let's head out to Rick Santelli in Chicago for the Bond Report. Rick.
You know, Sully, you nailed it. You nailed it. And everything is in the charts. It just jumps out at us today. If you look at 24-hour chart of 2s and 10s, look how everything changed places after all the data was out. And it wasn't only the 8:30 Eastern PCE. Maybe it was even more the University of Michigan sentiment, how some of those data metrics went lower. And 10-year note yields moved up and 2-year note yields were down. Now, why would it happen? Well, consider this. A week ago, the chance of a cut in September of 25 basis points was around 81, 82%. Today, it's much closer to 90%. So 2-year yields are going down because the Fed's hot for a meeting and their guidance hasn't taken it away. In terms of the long end, it's not so much about inflation. Think about it this way. If inflation was hotter, the Fed most likely would try to guide all the percentages of an ease down. But the data was pretty good on income spending, real spending, and that put yields in the long end a little bit higher. Look at 1 week, and you can see what I'm talking about in terms of yields moving down generically. There's your inflation, there's your Fed, but even though 10-year yields are a little elevated today, 24-hour chart of 2s, 10 spread kind of says it all. We put the steepening back in. These days, I would view steepening as the Fed's hot, and the long end kind of likes the economy. Because it was inflation moving yields up, the short end wouldn't like it as much. And finally, the chart of the day. This is the Move Volatility Index. That's a year-to-date chart. Look at how volatility after liberation has done nothing but go down. What does that mean in English? The Treasury market volatility, how much yields move? Well, the ranges are getting smaller. The close to close to close are getting tighter. Not necessarily a bad thing. That volatility is hovering at the lowest levels in 4 years right now. 4 years. So we want to pay close attention to how that index moves over the next couple of weeks.